Ugh. What'd I do? What'd I do? Oh, there's always a problem somewhere. Oh my goodness. What did I just do? All right. Okay, welcome everybody. I'm going to just get started here. This is GH2 Unfiltered. That's the channel I chose here. This is not, we're going to start in, what is it, just a couple of moments for 3, 2. It's GH2 Unfiltered here on your screen. This is the subscription website. So I'm going to presume here for the moment that you're a subscriber. If you want to subscribe, $30 a year, you get the free Substack and the actual extra stuff that sits in here, curated. I realize there are tons of different topics that I talk about. They may seem unrelated. They're actually exactly related. It takes time. YouTube is not helping matters. YouTube is not helping matters to you at all because they want to segment off everything into a 10-minute video. In fact, they're intentionally doing so. They're rating, they're posting and recommendations to people on channels, et cetera, based on this, right? They're intentionally tracking whether you're watching video 1 and then going to video 2 and then going to video 3. And if you do that, then what ends up happening is one of those 3 videos goes up on the recommended page by which you can get people to other additional people to view. That's the way the YouTube algorithm works. Okay, and I know this because, well, that's just the way it works. Please like and subscribe. Jay's Corner, maximize your Medicare. GH2 Unfiltered sits up here with deep end of the pool stuff. It's not there for mass, 100,000, even 10,000 views. I just don't think that, I think that people can get it. I'm trying to make it so that people can understand it. That all said, whether, most people are just on the idea, okay, well, I just want to know what it kind of means and then move on. First up, today's Medicare. So 3 weeks ago, I got an email. The email read that they thought that there was an omission, and a serious one, in the book. Don't even have a copy of the book here with me. It has to do with turning 65, being 65, and working at a small employer. Okay. Commonly, it is thought, and I'm going to show it to you here. So inside of the, I have that toolkit here. This is one of the reasons that you want to be part of GH2 Unfiltered. I'm actually giving you every resource you need, right? Every resource you need. And that's other than execution, but even then I'm giving you quotes. Okay. Right here. So here it is, page 21 of Medicare and You. Let's just blow this up a bit. Did it actually do that? No, didn't. There we go. Oh boy. What'd I do? Let's try this again. It's never any fun until there's a production problem, right? No. How did this happen? I don't know. I do not know how this happened, to be candid with you. Blah, blah, blah. Topics. Wow. Give me 2 seconds. Small production problem, which I think that I can take care of. I hope I can take care of. Nope. Medicare in Year is the official site here. Let's just take a look. I also have it up here. Maximize your Medicare, Medicare info. It's not the complete look here on the publicly available site by any means. Medicare and You here. You can remember it was page 21. We'll get there. So what happens is people believe that if you are working and 65, that Medicare is primary and that your group plan is secondary. People have presumed that that means that you must be enrolled in Medicare. Here it is right here. If you are 65 or older, have group health plan based on your or spouse's current employment, and the employer has fewer than 20 employees, Medicare pays first. True. True. There's nowhere that says that you must have both at the same time. Nothing here says that. People have wrongly read this phrase here. Period. This doesn't say if you are 65 and you are the current employee, then you must be enrolled in Medicare. Nothing here says that. Nothing. I can't be more emphatic about this point. Yet people, including agents, including health insurance company employees, tell you this narrative. It's simply not here. If A, then B. That's not addressed here. I'm saying not A, because Medicare alone does not fit this spot. That says if you have Medicare and you have the small group plan. I'm saying no, that's not the situation I'm dealing with. I'm saying only Medicare alone. Or more correctly, only the small group plan alone. A lot of Maximize Your Medicare, a lot, really has to do with there's a difference between what you can do and what you should do. And on that line right there, I don't cross it. It's everywhere in the book. The breadcrumbs are there. The bread, the loaf of bread isn't there. Why? Because that deals with other specific information or other not very pleasant things that I don't feel comfortable in having a printed book sitting in a small county library, right? Well over 1,000 pre-orders of the book going to libraries alone. That sounds like a lot. There are something like 18,000 libraries. So I'm still wondering what's happening to the other 17,000 libraries, right? Of which I get less than a candy bar per book. But anyway, so it's not profit motive. But my point here is that people have wrongly taken this. And not only that, as further evidence of this, we're going to move on quickly. Other evidence sit here, and it's bad. Because let's say now you're 66 and you decide to retire. In other words, people, because of the first misunderstanding, people believed that they needed to have original Medicare, even though they were covered by their small employer. The small employer cannot eject you. They cannot forcibly eject you just because you've turned 65. They're in deep doo-doo if they did. Deep, right? You cannot do that. That's a no-fly zone. When you then ultimately enroll in Medicare, because you've decided to stop working at your local hardware store. We'll talk about the hardware store in the second segment. You have to fill out two forms. One is 40B. Let's see if we can get there. Well, we'll get there in a moment. And the one here is this form here, all provided to you, okay, on the websites. There's no section here asking for the size of your existing employer. They don't, in other words, the federal government's not asking you this question. They simply want to know whether or not you have health insurance. They didn't ask you, did you have Medicare and health insurance? They're asking you, and it's here. There's no place to say, okay, what's your Medicare number? There's no place to say, where's the size of your employer? They're just asking, did you have health insurance between the time you turn 65 to now? Let's say you're 66. That's it. So for someone to send me a letter and say, this is an omission and a serious one. No, it wasn't. Wasn't an omission at all. And now you can understand why I got to the point, because I'm going to show you this. Oops, that's not good, is it? Let's get to another place and we'll see if, now that we're not using this website, let's use Google Drive here, and we'll be on to recent in just a moment. How much is it worth? We're going to get to that in just a second. But what I'm going to do is I'm going to add a tab here, because this is the nasty secret. Let's say you live in South Beach, right? And you are 65 years old. Your health insurance is $2,000 a month. That's the actual sticker price, right? I mean, that is not an exaggeration. $2,000 a month does it, right? So this is Miami. Now, the employer can't eject you here. Let's just say so someone is paying $24,000 a year, goes to the carrier. One way or other. There's also no rule on the split. Carrier does not care. They want their $2,000 a month. The reality is the following. Now, let's say this employee, the salary is $40,000 a year. And let's just say the employer pays $1,500. Leaves $500. This same employee right? Let's just say now, let's add some extra facts. This person is single. So this same and Mr. Perfect. And it gets worse if it's Mr. Sick-a-Lot. We can take them both. Doesn't matter. Original Medicare, the original Medicare, right at $40,000 is what? $170 a month. Medicare Advantage, PPO, Miami, $0 a month. Includes prescriptions. Medigap, what is it, $230? Can't remember. I can't remember if it's $230 or $270. The total, right? And PDP $33. Even in the worst case here, what do you get? You get $430 a month. And now you can see the issue, right? Which is over here, the worst case is $430 a month. Over here is $2,000 a month. Employer cannot eject the employee. That's a fact, right? Department of Labor would not look kindly on that. There's something, age discrimination. That doesn't mean that the employee needed to have both. We just went through that, but look at the financial difference. Employer's stuck because he can't change this rule, whether or not this person, the employee number one is versus employee number two, who's 35 years old, cannot. Yet this financial difference exists. I'm not saying the health insurance, I would put it this way. I'm not calling health insurance companies liars. They're also not out there telling you that this dichotomy exists. Because why? Because then the employer is going to try to eject them, which is going to be a violation. That's the huge no-fly zone. It's also not an omission in the book. And now you see the difference. That since Medicare and You tells you, okay, if you have Medicare and you have a small group, then Medicare is primary. Nowhere in Medicare and You does it say that a possible configuration is simply staying with your group plan. And this spreadsheet tells you that that's probably not an efficient answer anyway, leaving both the employer and the employee stuck between what they can do and what they should do. And that's why it's not in the book. Right there. Omission? Nope. Not an omission. Definitely not. Intentionally left out of the book because we know who's going to get in trouble if I try to say any of this stuff. In fact, I'm more than a little bit worried about actually even saying it here. I did say and hint to it last week without this level of detail. There's exceptions here, and I'm going to just quickly go to it now. You're employee number two, and you made $500,000 a year. You are the senior partner at a law firm in a large city, probably low at $500,000. The issue here is the math is different because while it's $200 a month, right now, instead, even if that employee is Mr. Perfect or Miss Perfect, right? Miss Perfect, right? The issue is this math and now the difference. That Irma could employee number two exists. This is why, again, not an omission. Not. Employee number three. Back to $40,000. $2,000 a month. Married. With spouse. 61 years old. 61 years old. Let's make it, no, actually, we got to be over full. sextuplets, 25 years old. Right. So now it's not $2,000 a month, right? It's $3,500 a month. Yeah. But if the employer is paying let's just call it the employer is paying half, even half. Right. That leaves you at $1,750 a month. Right. Employee is Mr. Perfect. That's fine. Or Miss Perfect. It doesn't matter. Spouse is Mr. Sicolat. In this instance, and 6 children on top. Now, $1,750 a month, right? Plus the out-of-pocket expenses can be lower than Medicare plus individually purchased health insurance, right? Because if the employee is ejected or employee is out, so is the spouse and 6 children, 7. So in other words, 7 people need to be insured. Can't be replicated at 7 to make these numbers work. There's another exception. And these are just the obvious, right? There are many, many other combinations, again, back to combinations, where this doesn't work out. Nevertheless, still not at 100%, not an omission in the book. We're done here. Let's go to the show. All right, so I'm gonna take you through this YouTube video because I think that this is, I try to play nice to some degree. You may not think so, but I'm going to show you this video because this is, I don't very frequently, I generally speaking throw rocks at CNBC, but because it's part of the fact that it's giving you a false narrative. But let's just take a watch.
Do you have any more clarity on where we might go now that this big earnings week is in the books?
No, this is actually exactly what I told you I was worried about. So I think, look, we have to acknowledge that this is the worst start to the year for 40 portfolios, which is what most of our viewers have some version of. 80-20, 70-30. In either case.
Okay. This is not news to followers here, right? We've got videos sitting here on Jay's Corner, worst start ever, right? Everyone knows this. If you don't know this, Jay's Corner, sitting up here. Nope. And this is not going to be a self-congratulatory thing, but I'm just pointing out to this is this past Friday. That video just came out, right? The fact of the matter is that, these things, the big stuff and combinations have been in evidence, right? This is not really that big a surprise. And certainly no one here who have been following for a while read the Substack. This Substack is chock full of nothing more than, candidly speaking, something's wrong, something's off. something's wrong, something's off. These combinations are telling us things that don't sit in the general narrative. I've known this, of course, and I'm pointing out, and the reason and that's why I like the timestamps, right? I mean, I don't get to go back and Monday morning quarterback and say, oh, well, without receipts. You have to have receipts, right? And in that, here it is. Right, and in this video here, you've got it, 5-minute video. Corner, I thought we would take a look at financial markets. Today is not financial advice. So, the fact of the matter is that we've known this, and this is going to
back to 1980 to find a year where stocks were down double digits and bonds were down worse.
Last week, if you watch last week's live, the third hour, all there.
No place to hide other than cash. Even a 5-year treasury, you got slaughtered on duration.
Absolutely correct. So again, this is a person who is not, he's well known, and this is correct, right? I mean, and that is part of the reason for the entries on the Substack, which is that to show you that this performance here, and again, BlackRock, best of class, minus 12% year to date. It's been a very long 4 months, very exhausting.
And in that kind of environment, you have to learn technicals.
And again, back to here, right? So, you can call them random lines. That's okay. Last week I said, look, this stuff doesn't matter. It doesn't matter if you think that it's a random line generation exercise, right? If the market is watching the lines, then guess what? Then what you're going to have is let's just not go to that part. Let's just actually look at the line of the Substack itself. You're going to scroll down here and you see Apple a day, then you see all these different things. Yay for the book. If I were a millennial, that's me. Anyway, if you see here, and on we go, but you can see how far back this goes. Netflixosaurus, almost every day. Millennials should definitely read this. There it is. Inflation takes no prisoners. Withdrawal could be worse than the addiction. This is dated end of January. We're now 3 months later with a straight line down, basically. And not only that, you've got, right, this is what is this date? So this is the middle of April. Fine, we've known this. You'll keep scrolling down here, and what you will find is this line, and I'm going to show it to you live now because I didn't actually prepare for this, but you can see here, this is the S&P 500. Those lines told us very, with a high probability, I didn't say certainty, high probability that I drew this line. Shut this down. I drew this line right here. The people watching the pictures and the random, the idea that this is purely random and that somebody, and could be program trading, everyone's was watching this. And there it was, right here in this 4170 to 4180, and then now breached. This is not great. That's Jay's code for this is bad. In fact, last week I said that we were very probable to come back down here to revisit this spot. And even after a fierce upwards on Thursday, the other narrative did exist, right? Because you were here and could you have gone back up? Yeah, but we didn't. Instead, we went straight back down and more. For the worst April, something like 12th worst month ever. And so we go.
You can't be one of these people that comes on in January, February, March, arguing with me, telling me, oh, this is a great company. Yeah, we all understand that, but the stock is for sale 4 out of 5 days. And then we have these green days where the Dow goes up 800 points, and everybody forgets you're in a downtrend. You're in a bear market in the NASDAQ. You're in a statistical downtrend in the S&P. As of right now, we're going to finish this month, as I told you, below the 10-month moving average for the first time in a long time. This is not an environment that's rewarding fundamental happy talk about.
Exactly. The reality is, fundamental happy talk is the false narrative that depends entirely on this equation. Fundamental happy talk depends on this equation, period. I don't know how to say this any more plainly than that. Fundamental happy talk about the management and earnings has to do with this numerator here. And it presumed that this 1 plus I to the T is stable and known, which no longer exists. This I here is interest rates. The primary determinant for risky assets is interest rates. And oh yeah, by the way, nobody really understood, the general public doesn't understand the way that interest rates work. And that's why stocks for show, bonds for dough. Very simple. It's not only that interest rates are low, but it's a secondary thing that interest rates have been predictably stable. There's been no volatility here in this number, right? Everyone knows about volatility over here. That's okay. Apple is great. Amazon prints money. Netflix has all these subscribers, and we've got this debate, but you do have a consensus. You'll have wild misses, but you have a consensus. You can look it up for every company. Just Google whatever company you want. You will find a consensus by Wall Street analysts who can be wrong, right? But you do have a number. Over here, everyone's universally been, for the most part, and the reason for that happy talk persists, and especially over the last 20 years, is because I has been this flat. And since nobody, you just glossed over it. You glossed over the single most important parameter, allowing happy talk to occur. And now on top of that, and we'll get to Amazon in a moment, right? Which is that now all of a sudden you get big problems up here. Who are you? You turn into Netflix. You turn into Facebook. You turn into Amazon. Twitter, I don't care, right? Twitter's market cap is too small to matter. Netflix doesn't matter. Amazon, Apple, they matter, right? Why? Because their market cap is what? 10%, 7% of the S&P 500. So you have this, so we've got this happy talk, meaning that we've had some glossing over here. And I understand that that is stuff that people can understand. But the reality is down over here, I has been so flat to stable. And the reason I brought up the thing with art is because that is not well understood. And I know this, for some persons, this is going to be repetitive because, they've read the Substack, they've read the newsletters, they keep reading stocks for show, bonds for dough. They keep hearing me talk about the fact that that's my spot, meaning that that's the place that I began. That people don't understand the math of this. And then we are not even to the ripple effect here. Because down here under I, and I'll move this over. I down here does not, so let's just say this is a company, right? And let's call it Amazon. This, by the way, also is your rental property, right? You're receiving rents, you're borrowing on a mortgage, right? Your mortgage has to do with the risk-free interest rate plus specific interest rate. Now, in other words, Jay's Rib Shack does not borrow at the same rate that Apple Computer does. Right? Jay's Rib Shack is riskier. No question. Everyone has their own eye. And not only that, in reality, this is a time series, meaning that this, this is a watered down version of this, right? This is T, where T is 0, which is now 1, which is the next time period, and on we go into the future. Well, guess what? We've had this plug number of I here, which has been like known. And if anything, going down. Now, all of a sudden, if I goes from 3 to 4, let's just make up a number. This number here, NPV, is down. What's there to say? The concern in the setup here is we've not talked about the ripple effects hardly at all. Not yet. Right. Meaning, what I mean here is the feedback loop here from I back up to R and then back to N and to what NPV actually is. Also, you will have to flip over rocks really aggressively to be able to connect the dots. Okay. You'd have to know a lot, relatively speaking. So now let's just take Jay's Rib Shack. And I did discuss this. Nobody watched this video, by the way, about the bond market. Right. I'm making money as a result of the fact that borrowing costs are low. I get to take my extra money. I get to, put up fancy signs and create advertisements. Right. Let's all of a sudden say now that my borrowing costs go higher. So now what happens? I have to cut costs. I have to not hire the chefs that I want. My inside of my restaurants are not as clean. I've not made as much money. So what happens? You feed back to the R. And now all of a sudden, oh yeah, I can just go to Chipotle and not to Jay's Rib Shack. Chipotle has better food. Chipotle has, etc. ingredients. It's always spick and span. Gets worse. So now let's just say Jay wants to sell his Rib Shack. So I'm the sole, and of course, obviously, I don't own a Rib Shack, but and the entirety. The question is okay, well, now I'm out. I'm tired of being a Rib Shack owner. I want to sell myself. I want to sell Jay's Rib Shack to Jim Bob. What does Jim Bob do? Buyer looks around and compares. Other restaurants. Other investments. And then what does he do? So now what does he do? He goes and finds, Sally's Deli. And Sally's Deli isn't let's say you can even calculate R and you can calculate I. And even if you had accurate projections, the fact is that if you have other investments, new buyers may just say no. Right? So what ends up happening is the company doesn't sell at NPV. Right? The company actually sells at value is some multiple of NPV. Yeah. Well, do you ever see this? You say, okay, that, that sounds like ridiculous. Why would I pay a multiple? Yeah, you see this all the time. You have your PE ratio. Right now, there's Amazon. They're not trading at exactly, some this year's earnings per share. They're a multiple of the projected next year's earnings per share, which kind of represents this time series. The issue here is that as interest rates increase now, part of a very important part here is that you've been banking on the idea that interest rates have been so low that this other investments was invalid. And we're not there yet, I don't think. Otherwise, we're going to have a snowballing effect, and it would be much worse than now. Much worse. We are not yet even starting to this spot here, but it is there. Right? Part of the reason that people have bought stocks is because interest rates have been so low, there is no alternative. And you can look on Google, look up Tina. There is no alternative, Tina. None of this stuff is in the market. Not really. Not yet. Oh yeah, by the way, who are the persons in here? This is not just, Joe entrepreneur buying this stuff. Who's the person looking at Tina? Oh, Bank of Japan, Swiss National Bank, Norway Oil Fund. Right? You're 100 shares of Amazon. And that's why I like this point of the over here.
Fundamental happy talk.
Fundamental happy talk, right? Is even if you got all of this correct, if you start pounding interest rates higher, which the Fed has not yet actually begun, you open the door to these other ripple effects. You open this door up here, and now all of a sudden these banks, these big groups who don't care about Twitter and they don't care about, Kathy Wood's ARK fund, they start hitting the sell button. You're not down 12%. You're down double, easy. And this, I don't think is in the market. And that's what I was saying, Dar. Right, which is that when I said in that video, the 6-minute video, I said, if anything, I wildly understated the full ripple effect. I didn't want us to go down that wormhole because we would not be able to resolve it. I would not be able to explain it to the degree that I am here today. That you can see what's happened here down this list. And this is, Jay's not splitting atoms here, right? There's nothing here. No one's going to send me an award for any of the stuff I revealed over here, right? You take somebody in finance, they're going to shrug their shoulders, even if they haven't thought about it in these metrics, because what ends up happening? Fundamental happy talk has to do with R. Ignoring both the biggest number, of which the biggest groups of people far bigger than anybody who gets rewarded for getting R correct is involved. Not only that, during that period, what ends up happening, remember I told you that this is some multiple? And the ripple effect of this here can be this. That the re-rating of all of the stocks, all of them, declines. And you'll see it, and we don't have it here, it's beyond today, right? That the average PE, and this does matter, is, let's just call it like 19. I want to say, I think it's like 19. And the average is something like 15 or 16. Let's just call it 16 to be, glasses half full. Right? So that means if you drop 3, even if the numerator, the happy talk, is correct today with no ripple effects, right? I mean, or that they think that they have the ripple effects right, which I don't think so, because of the fact that I've just under Jay's rib shack these issues. Right? We're not even talking about the consumer yet. We've not talked about the consumer yet, by the way. You've lost 3. That means another 16% down. That's just to get to the average. That's not talking about out of a much higher increase in I than expected. That in fact, that if you think through how this could work out, that you'll see why I've got these other pictures. And now you can see the link to all the other videos. You will see it here. Followers for years know that I've shown this picture. Basically, the fact that I has been this low and stable has lulled everyone into happy talk that we're sitting on the blue line, which no longer exists, period. And you could say, okay, in the long run, that will happen. We're going to get to that one as well. We'll get that at the bottom, right? So the happy talk, so that's why these other graphs, and you can see it. And, I'm happy for this snippet because, well, either this person and myself are the only crazy person, which we are not. We will have this other person's as well.
As I told you, below the 10-month moving average for the first time in a long time. This is not an environment that's rewarding. Now we're going to finish this month, as I told you, below the 10-month moving average. NASDAQ, you're in a statistics, and everybody forgets you're in a downtrend. Then we have these green days where the Dow goes up 800, but the stock is for sale. 4 out of me telling me, "Oh, this is a great company." Yeah, we all understand that, but the stock is for sale.
Right here.
Telling me, "Oh, this is a great company." Yeah, we all understand that, but the stock is for sale.
We're going to get to Amazon specific.
Telling me, "Oh, this is a great."
Oops. We do need to hear this because
you can't be one of these people that comes on and inject that kind of environment. You have to learn technicals.
And now you say have it in the emission, and that's the whole point. I'm going to leave the link of this video. I don't know what to tell you, right? I mean, we've been sitting here. This is what, February. Market traders represent a high probability revisiting the lows. And then again last Sunday, I said high probability, not 100% certain, but high probability. Why do that? Why? We've simply moved from the blue to the yellow. You have to widen your expectation set about what is possible. Very, very clear. I'm going to turn this to stop. And now you can then, of course, see the link to other other statements that I've been making here on the channel, which is that, and pretty much to every person that will listen. Of course, that's different. We'll get there. We'll get there. Where is it? So just so you know, because of the fact that we have very terrible production over here, right? Which is, the fancy guys will have chats and all this stuff like that running up and running. I will check the chat in a few moments, I promise. So if you have your questions, by all means, go ahead. That's not going to be a problem. Where are we? Darn it. We're getting there. I guess we're not going to get there. Yes, we are. Right. So, of course, we come back here. We come back here. So now it's directly related to here. Because now all of a sudden here, right, this curve, you thought that this is, just like by some coincidence? No, that's just this. And why I've been saying, and why I'm continuing to say, that we're going to have to widen your berth here. That curve is not the blue line that you see there on your screen, right? It's flattened. And that what that basically has introduced, right, is that has also widened the width of the possible up and down. So you're going to have bigger wrong and bigger right, which is entirely consistent with plus 3%, minus 4% day to day is astounding, but expected. I've been trying to connect the dots with you, right? Because knowing full well that kind of giving you the entire loaf is like, it's not reasonable for me to expect other persons to have this all in place. Of course, if you're a person with advanced math degree, if you're a math major from college, you're looking and listening to these, and maybe you've not heard the translation in this way, but you're looking at the math of actually what's going on. You're like, okay, Jay, you're like a moron. Like you've told me nothing mathematically that I didn't already know. And, I've forgotten more math than you've learned in a lifetime. And you're right. 100% correct, right? Market dynamic about, however, the mechanism of financial markets and the way the ripple effect and the feedback loops, however, actually work. This is not in the mainstream media. You'll hear snippets, right? But because of the number of shortcuts, what you have is Josh Brown's happy talk. That's what he means.
You can't be one of these people that comes on in January, February, March, arguing with me, telling me, oh, this is a great company. Yeah, we all understand that, but the stock is for sale 4 out of 5 days. And then we have these green days where the Dow goes up 800 points, and everybody forgets you're in a downtrend. You're in a bear market in the NASDAQ. You're in a statistical downtrend in the S&P as of right now. We're going to finish this month, as I told you, below the 10-month moving average for the first time in a long time. This is not an environment that's rewarding fundamental happy talk about how great the management is or how innovative the software is. Nobody cares. Stocks.
Exactly. So yesterday, in preparation for today, I scrolled, unfortunately, I scrolled on YouTube just to see what other persons would say. And I'm hearing, and we're going to get to Amazon right now. I very rarely opine, but now you'll see the link about a particular company. Somebody wildly missed up here, right? The estimates were wrong, right? That can happen. This tells you it can happen, right? That while McKinsey people are sitting outside the warehouses, right? There's error involved in estimation. There's error involved in hurricane forecasting. The persons creating hurricane forecasting models are not dumb, I assure you. The person creating the forecast of this are not dumb. I'm not saying that for a moment. Not for a moment. I am saying, however, though, that those are estimates. And now, under this circumstance, when I is this unstable, that the feedback loop will be that R will be more, and the possibility of being more wrong also now is no longer the blue line. It is now down, yellow, red. So all of it, right? As a result of all of that, what has basically happened? The feedback loop will be almost certainly, right? So now all of a sudden you don't know what the PE ratio is. And now what happens if interest rates are higher, these big guys, and this is just example, right? I mean, these aren't the exact parties. They could be demanding a higher, right? They may not care about stocks until you get down to a much lower affordability multiplier of the NPV. In other words, they don't want Jay's Rib Shack if all they can make is X percent. They want Y percent, which is much more. What does that mean? Lower prices for Jay's Rib Shack. And if that person has way more money than anyone else, like these groups do, there is nothing that all the people, the happy talk can do about it. Nothing. Not a thing. Let's talk about Amazon. We'll be done shortly. No, we're going to get to Amazon, then we're going to talk about this grid here, because that'll be the punchline. So let's talk about Amazon just for a moment. Here's my issue, right? So you've missed on the top line. And now the question becomes then, okay, what are you going to pay? And somebody said, oh, we're down 15% in a day. Wow. So, and then the defenses are going to be, well, Amazon is not going bankrupt. Okay, that's not the same as minus another 25%. In other words, Amazon could still have its same market share and the stock price still be 25% lower from today. Is there any difference? Is Amazon Prime going to be like out of business if Amazon stock is down 25% from this spot? No, it's not. This is not about that. So it's just funny to me when somebody says, oh, well, Amazon's going to be fine in the long run. Netflix is going to be fine in the long run. It's going to be a survivor in streaming space. Yeah, you could make that argument. I'm not even going to dispute that. I probably suspect you're right. Please, I hope Netflix doesn't go bust before the fact. I've got to finish the second part of Ozark here, right? And I heard Stranger Things coming up soon too. I want to see that one too. Please, I hope Netflix doesn't go under. Sure. That doesn't stop the stock from going down 25% from that spot. Doesn't. Most concerning here, and to give you an idea about how far off base some of this stuff, when we hear, we ran out of time here, but the reality is that there was a second video after this Josh Brown, because there was another 20-minute video on Happy Talk from an analyst on Amazon, about this, that, and the other, and making excuses about the fact that ARM was this far off and the fact that it would be survivor in the long run. We'll talk about that, and that's that red grid at the end. The issue is that Amazon is like, let's just call it broadly two businesses. Okay. We've got the retailer, right? And we've got web services. So I don't know a thing about the split out here. I'm very sure this is not 100% and that this is 0%. So let's just for kicks. Let's just for kicks. Let's call this 60%. Let's call this 70%. And let's call this 30%. Right? In terms of their contribution to the profitability or, revenues of the net revenues of the company. The issue is that the market is not going to be the same for these two businesses. You see what I'm saying? So in other words, or better yet, say like market times 80%, and then market times 250%. So in other words, let's say the market as a whole trades at 19. I put in 19, right? 0.8 of 19, and I don't know what the answer is yet. It's 15. Okay. And 0.3 times 2.5. 0.3 times 2.5 times 19. Right? So if you add these two, this is the blended weighted average, right? So you can see it is 29.45. And I'm making up the number here. Don't get me wrong, right? This is hypothetical. But I'm saying that today, right? I want to call this what, 50 odd? 45 odd? That's down by a third from here, which is already down 15% overnight, which is down another what? So the idea that somebody says, okay, well, you can be it's going to survive in the long, that we're not debating that. How's that even a part of the conversation? And this is just me back of the envelope, right? Like I said, I'm not a person who's predicting R at all. I do know how weighted average works though. And I also know that Amazon is not just one business. And if I broke it into two businesses, this is why conglomerates basically failed, right? You can remember ITT, for example, right? Multiple different subsidiaries with some, corporate finance theory, which didn't work out. General Electric broken up, right? Which is that you have different multiples being assigned to these different segments. And when they're this far apart, that you can see what could end up happening here is that, oh yeah, by the way, if people don't like retail and they start throwing this away, and it's 70% of the company, and instead of the market multiple, let's say it's, let's say it goes down to 50% of the market multiple. And oh yeah, by the way, we go from 19, this is assuming 19. I did not even talk about the idea that the market as a whole could go from 19 to 16. right? I've assigned it some ratio based on the market as a whole, as a reference point. So if if it's saying retailers are bad because, low income is going to get pinched by inflation, for example, in a scenario you're going to see for sure without a crystal ball, that's not heroic, prediction. And yet web services, because everything's still going to be done online, and because, maximizeyourmedicare.com still needs a website. And so it gets extra credit for the fact that I have to pay their bill in order to keep this stuff going. Wonder why I do that when I get $1 or less than a candy bar per copy of the book. But anyway, that's that's my own problem. You can see what's happened over here. So this is the real indictment of Happy Talk. Is that what's in the market all the attention here of Happy Talk is up here on R. But down here in reality are these other huge layers, huge, right? Tina exists. This could exist. If you increase interest rates 50, 75 basis points, so 2%, 3%. Now all of a sudden, what happens when the big guys actually look at this? This is not only in foreign markets, right? And I've not even talked about the fact that, oh yeah, by the way, that they could sell today and get more of their domestic currency, which has also increased their return by another 5% because dollar assets are so strong, because the dollar has gone on a incredible run compared to the Japanese yen. And now you also tie back to the newsletter on why I made note of the fact of something big is going on back there that we do not see, and you will not be told, nor will I. Not even if I flip over rocks very aggressively, I will not get this story. They're not going to send you a memo or me. No. Nope. The reality is that, I could have just hit record on Josh Brown's, thing of Happy Talk, and could have used it any of the entire time. You've simply gotten away with it because I has been that stable. It's not only been low, but its volatility has basically, if anything, it has been narrower than this blue line here. Narrower than the blue line. The graph on your right. So as a result of that, we got to play, wax poetic about R, and all of a sudden CNBC and all these persons are sitting and talking about how great they are about the management. Happy Talk. And now that I is volatile, then you can see this person saying that stuff doesn't matter, which has been my point the entire time. It doesn't matter. I is the one driving here. And the ripple effects here still aren't in the market. That's what I said to Art. That's what I was saying to Art, which is that interest rate which other people can just in everyday talk understand as inflation, isn't sitting here in NPV. Not yet. Pretty sure. Despite all of that, do you think that this could be the bottom? I'm not telling you here also that the world's going to end. There's nothing to say that this is not 2008. No, it's not. In a weird way, it can be more challenging than 2008 because now you don't have a good, easy fix here. Like 2008, the Fed just piled money into the world. That's what they did. They said basically, look, all you money market mutual funds that were all actually not worth $100 for your $100 deposit, I've got you. That's what the central bank did. right? There's a financial structural problem. They're the ones at the backbone. They said, no matter what, those groups are not failing, period. And yes, did you have bailout nation? Of course you did. But that you won't hear me throw a rock. They were extraordinary duress, much worse than the public knows. Much, much worse. But Fed had the ammunition to be able to deal with it. They don't have the ammunition here. And they're telling you, if anything, the ammunition is going the other way. All right. Almost done. In the long run, stocks outperform. True. In the long run. As I said, you know, this is not my chart. This is one, however, you can see GH2 Unfiltered has sequence matters a lot. And here it is. In the long run, stocks, this, that, or the other. First of all, let me just say that in the long run, that has also been because, you know, this I has been going down and stable for 40 years, right? Straight down. It's not only since the financial crisis, by the way, right? Straight down and stable, both. It's not only down. The blue curve worked, not the yellow. But look what happens. Yeah, in the long run, stock, you can make any statement, whether true or not. Let's just presume that the happy talk is correct for a moment. But we're here today at the end on May 1. And markets are down across the board, right? And you'll see it on the Substack, on the newsletter. Please go on the newsletter if you're a newcomer here and didn't know this existed, right? The targeted retirement funds are down minus 13% year to date. In order to, and you can see it, what happens here. This top group, this top panel shows you that what ends up happening is this is going to be the same average return. But yet at the end, book A is much better than book B. Much better. Right? That the value of book A at the end of year 7 is worth a lot more than book B. This is actually the link then to financial planning. You don't get to you only get to take cash. So now let's just say this is my point here, right? So now you're at the end of year 5 after you've taken a minus 40, right? And at year 5, you have an emergency. Costs 5. So in addition to that, this 105 is not 105. It's actually lowers you down to 100. So that new number here, this number right here is not 105, it's 100, right? Because you've spent an extra 5. And then that goes up by 10%. And now that 121 is no longer 121, right? It's now 110. And now you can understand the issue. That first of all, you can see how average is just a number. That sequence of this type of thing, of a big drop in any point in time, and especially at your beginning, throws off all the math. And you can see that the amount of money that you have to redeem at any point in time here becomes an issue. It's why I reject the idea, okay, well, you know, yeah, if you're here and you're 35 years old, right? I'm trying to find an extra dollar to be in. Why? Because I know that this number of years is 40. Okay. Got it. Right? There are scenarios that I'm like saying, okay, well, this all returns back. Yeah, but T is when? Right? This is sometime in the future. If any time before then, you have to have a -5. Now you're going to erode, and then really erode. Meaning that this is the point back to the two combinations, right? I can figure this one out by itself. I kind of can. How? I lower my spending. I don't, this or that. I don't go on vacation. I eat budget food, not to, order out that many times a week. Okay, I get it. It's not as easy as that, of course. People know that, right? It's easy to say, I can cut my spending and that'll solve it. Not that simple, right? Inflation is going the other way. So now, but anyway, you can see what here, and this gives you an idea of the magnitude now, right? We're now down minus 13%, as I said. You don't get bad. So in other words, if you had 100, again, you're at 87. You were at 100. You're now at 87. Okay. And now you're going to have to take your 87. And then this is, let's just call it 2023. And this is what I do for comprehensive clients, right? And you start plotting. Right. And what you thought, let's say here. And instead, you're at 87. Right. And you've been thinking, what, 6%, let's just call it 7% a year. You thought you were going to be at 107. And then you thought you were going to be here plus 1 plus to this. And so on. That obviously is not it. Not write the formula correctly. My mouse is screwed up today. This is like terrible. That'll do it. Oops. Right. So you presumed 114 at the end of 2025 is going to be, I still didn't do it. Where's K? Oh. Right. So with the compounding, you thought it was going to be worth this. So from here, the rate at which you've got to get in order to get to 122.5043, and I'm not going to decompound it for you. Right. You've got to go up by 40.8%. And it's less than that. Right, because there's compounding effect. But my point is that even if you're, just to give you an idea, if you're at even if you're at 11%, what do you get? Even if you improved to 11%, you're not close to each other here. right? So you have, so when, and someone has nicely stated it. It's not only that you've lost, but, and then when you have these losses, the amount to make back to the spot to which you presumed and planned for is now off. And it's off, and you're off by 1%, you're okay. We're off by 13%. You're not off by 7%. You're off by 20%. And this minus 20% compared to your expectation absolutely does, because we've presumed that no change here to the outflow. This is just the top line. It's kind of why I say, when people say, okay, well, I'm investing for the long run. That is very nice, happy talk for when these numbers are, minus 4% versus minus 4.5%, or, 7% versus 8% in a given year, not at minus 13%. All right. I don't want to have this keep going. I realize that people, I did this intentionally and trying to keep it short. You might not think so, but right. I am trying to keep it short. I'm going to try to go here to the chat because, like I said, I don't have good command of. I do not have good command over the studio and the production and stuff like that. I should have other software and this, that, and the other. I don't have time to research it and, figure it all out. I don't want to have something where I didn't want to have something where I, produce it. If I produce it, then who the heck knows when it comes out and all that kind of stuff. All right, good enough. All right, good. I think there are no questions. I'm going to pretend like there are no questions. All right, everyone. If you have questions, you can leave them in the comments, and I'll try my best to answer within 24 hours. Thanks.